Welcome to the daily update, where I'll go over the action in the market for Thursday, May 8th, and we'll see how things look for Friday, May 9th. Okay, had an update, but we gave back an awful lot of those gains going into the close, and that's not a real good sign because it's the amateurs who open the market, it's the professionals who close it, and they decided to sell near the end of the day. We still ended positive. The short term's looking pretty good. We're a little bit concerned about the intermediate term. We are improving, but we're not seeing an awful lot of strength. And in fact, we're switching into a trendless environment. And I'll show you that when I get to the ADX chart. But when you measure things based around the moving averages, we're still positive in the short and intermediate term. We're still negative in the long term. We'll have to see if the market's able to get above the 5,700 level and then stay there. We were above it, and it looked like, okay, maybe we've got a shot at breaking that overhead resistance. No, going into the close, that didn't happen. So let's go back and talk about what happened. Right at the open, we had a gap higher open. The futures were pretty strong. There was this announcement that there was a trade deal between the U.S. and U.K., and the market looked at that with positive anticipation. And then the announcement came and the market liked that. And then later on in the day, they're like, wait a minute, is this the art of no deal going on here? There really doesn't seem to be all that much substantial. It seems like just kind of the framework for something, not an actual deal. So there's some skepticism around, is this what it's going to be like with the talks over the weekend in Switzerland between the U.S. and China? A lot of, well, we begun to start to commence, or is there going to be something more substantial that the markets can really grab onto? And in the meantime, when the tariffs were first announced, that pushed us down. Then there's been some little bits thrown back out saying, well, we've got a deal here, we've got a deal there. Maybe we're going to tune this back a little bit. And that's been helping the market bounce back up. And is this what we're going to have now for a while? At least from a trending perspective, it looks like the market could be chopping sideways. Now, we don't know how long that's going to last, but for right now, that's what the charts are telling us. Okay, so there was optimism right at the open, and we opened at R1, 56.64, and then we drifted down to 56.50. Not only are round numbers kind of important, 57, 5600, so forth, the 50 levels, and even 30, 40, 70, 80, those can also be considered to be just round numbers that the market likes to latch onto. So we got down to 56.50, and then we climbed above R1. So we took off now. We got above R2 at 56.98, which is just about at the 5,700 level. And then we did get above 5,700, and then we hit resistance at 57.20. And we declined back down below 5,700. We tried to find support at R2, but then going into the close, we ended up going all the way back down to R1. And I'll show you the chart of all of this. So we were up 0.58%. We were up way more than that earlier. Volume is still below average. And we've been watching that. Up days, down days. There's still a real confusion confusion about this, showing a lack of conviction as to what's going to happen here. So we are still positive in the short and intermediate term because we're above the 20 and 50 period moving averages. Negative in the long term. Interest rates did go back up. We'll be getting some inflation data next week with CPI. And a lot of it had to do with, okay, we've got a deal. We've got a new pope. Well, neither one of those things seem to really be what the market's looking for. Okay. And the pope, yeah, that's separate completely. But the trade deal, it's like, okay, let's positively react to that. And then let's look under the surface and see, can we find any details? There's really not much here, not anything that can we can really use to make a decision about the market. So again, more ambiguity as we go forward from here. At least that's what I'm taking from this. We'll see if anything develops over the weekend with the talks between US and China. That's the big one right there. Okay, so the Trump administration announced a trade deal with the UK. This gave into a lot of optimism that deals will be reached with other countries. Well, have we really even reached that big of a one with the UK? And that the tariffs may be less impactful than feared on the global economy. That's why we went up, because that's kind of what has been we've been led to believe with where we're at right now. And then Commerce Secretary Letnick said that the 10% baseline tariff will remain in place, and that was expected, adding that the UK will purchase 10 billion worth of Boeing jets. Now this is interesting because I come from the Pacific Northwest, and Boeing has always been a huge part of the culture there. Even if I I had friends and even family that worked at Boeing, but if Boeing does well, the whole area does well. And there's all these other companies that feed into Boeing. And but then you have the competitor in, making jets in Europe. It's like, okay, don't you think that the UK would anyway, it's just weird how all that works sometimes. Okay, then Trump came out and said that the US is very close to additional deals with other countries. Well, close, but are we there? Specifying that tariffs on China could be lowered if this weekend's meeting goes well. Well, what if it doesn't go well? Are they going to go up to 300%? Trump added he may speak with President Xi after the meeting. Well, that's good. If they're talking, that's always a good thing. And so you can't help but be cynical because we're dealing with a business negotiator as president right now, and it may be all under control as far as the administration is concerned. It kind of sends a roller coaster effect throughout the stock market and just being a member of the U.S. economy. It can really create a lot of whipsaws here. So, late afternoon reports indicated that the U.S. is considering lowering tariffs on China to 50% next week before a long trade deal talks begin. Okay, so, but the market went down. They didn't really react to that all that much. And as I start to record this about 8 or 9 hours before the market opens, the futures are up a little bit, but not very much. So there wasn't really any reaction to this late day report. Then the VIX is back under 24 because we had the update. We're still above 20. That's the concern, is that even though we're at 23.55, we're still above 20, and that's just showing heightened volatility compared to what we had seen back in 2023 and into 2024. Then the New York Fed released its April survey of consumer expectations, showing no change in the year ahead inflation expectations. So this report says inflation is going to be 3.6%. Looking out 3 years, they raised it to 3.2% from 3%. 5 years out, they actually see inflation coming down. It'll be at the expectations are it will be down to 2.7% from 2.9%. Okay, now here's our short-term list. The usual charts that are on this list, except there's one CCI chart on here, but not both of them. So we have the Stoch RSI, the Williams percent R, CCI 20. That's a little longer term. I have a 14 period and a 20 period to get more of the short term and then a little bit longer short term. The stochastics were back to far away from the 20 period moving average. That's what the boom 20 means. And then the slope oscillator, it looked like it was rolling over. Well, with the update on Thursday, we actually turned back up a little bit, but it's extreme positive there. But we don't have the other short-term indicators that suggest maybe we're really overbought in the short term. So this means, okay, maybe we still have some room to go up here. In the intermediate term, the TTM squeeze, which had started to turn negative, is now turning back and looking more positive. The PMO studies, and then the bullish percent index for the S&P and NASDAQ 100. And I'll show you charts of all this stuff here. Then, no, I didn't change the scenario because the Fed didn't really say anything. They're like, well, we're just going to kind of keep things the way they are right now until we see more data coming out about what's going on. And the dollar was up, and that kind of helped things a little bit there, at least from a dollar perspective. And interest rates were up. All right. We jumped quite a bit there. We're at 4.37% with the 10-year yield, where after Wednesday we were at 4.28%. We're still looking positive though as far as sentiment. We're not buried down below that 25 range the way we were there for weeks. We're coming in at 62 where we jumped up from 56. We're still back to being normal now with the 10-year to 3-month yield curve. It's like one day it's even, the next day it goes inverted, the next day it goes back to not being inverted. We're just dancing all around. At the very end, I'll show you that chart. And now we're not trending, both in the short and intermediate term. I use a thing called the ADX, which the main indicator itself, and then I have a moving average on top of that, and then there's red lines and green lines. But I have a static level at 20. And when we drop below 20, now other people that use this indicator, you might use 25, 30 even. I found that for the S&P 500, 20 is a good static level. When we're above 20, we're trending. When we're below 20, we're not trending. We're back below 20, both in the short and intermediate term. So at least for right now, we're not in a trending environment. And it's continuing to go down. That's what I mean here by the ADX is weakening. It's still going below its moving average, but we're actually, I should have changed this. Sorry about that. This should be below 20 now. And with the up day, the bias is positive. That's usually an up day, down day. And I'm still keeping the momentum at mixed to positive. We'll see if the market looks a little vulnerable at some point, especially when you see late day sell-offs. Okay, so we had weekly initial jobless claims, and I don't have the charts for this. I get them from stockcharts.com. Their charts weren't updated, so I don't have anything to show, but it actually came down. Where a week ago we were a little bit concerned. We came in at 241,000 initial claims. Well, it dropped back down to 228, and that's more the range that we've been in lately, where the market expected it to come in at 238,000. So this is showing, all right, maybe the employment situation is holding up, and that's also borne out here. Continuing claims, 2 weeks longer, actually dropped a week ago. A little bit of a concern. We were breaking out of a range to the upside. Now we're coming back more into that range at 1.879 million, where we had gone up into the 1.9 million. Then this is kind of a big deal and kind of negative. This is probably why interest rates went up because first quarter productivity came in down 0.8%. Now, if you have a business and if you're a stockholder in that business, you want them to be producing. Well, it's going down and it went down more than they had expected. They thought it was going to decline 0.4%. Last time it was up 1.7%. But then this is also more negative. The first quarter unit labor costs were up 5.7%. Last time they were up 2%, and this was greater than the 4% expected. So we saw productivity down and cost up. And from a business perspective, from a shareholder perspective, that you want to see the opposite of this. You want productivity up and costs to go down. Wholesale inventory is not a huge impact there, up 0.4%. We're keeping an eye on this. I always watch it anyway, but we're seeing if there's any front running ahead of tariffs going on here. It's actually less than the 0.5% increase they had expected, but up from the 0.3% we saw last time there. This is really the only major economic chart that I have. So productivity going down. Now, unit labor costs on a year-over-year basis are declining, but we're seeing this climbing with the reports that we've been receiving lately, and it actually was going up. So what held this together is, okay, if you take a bigger picture look here, okay, the blue line going down, we don't like that, but also the yellow line is going down as well. And this shows the wholesale inventories where they're still positive, but coming down from what we have been seeing earlier in the year. All right, then looking at the buybacks. Now, this is considered to be something positive. Now that we're kind of coming out of earnings season for the S&P 500, there's still some companies left to report, but the bulk of the companies have now reported. They're out of blackout now where they can't announce it or do any buybacks or anything. Well, now we're seeing this really stepping up here. And that's considered positive, a company buying back its own stock. And that usually is positive, and it usually happens in positive environments when we're going up. And companies buying back stock at record pace. All right, so we're seeing this kind of confirms what we just saw. It's a Bloomberg chart. And then the S&P, if you take out financials, real estate, and utilities, it's like, okay, if you follow a baseball team and you don't count their losses, they won every game. You can manipulate this stuff here, and they're just projecting things with tech actually continuing to go up. And then if you take out tech, they're showing that there's less growth, but it's still going up. And this is what they're anticipating for the S&P itself. Okay. We expect year over year core PCE inflation to rise to 3.8% in December 2025. Okay, that's a nice, what, 7 months away from now, and remain above the target in 2026. Okay, that's what, 10 months from now, whatever. I mean, it's like you can forecast whatever you want. I personally do not forecast. I look at things where they're at right now. People love forecasts. That's why the weather is so popular when you watch the news. What's it going to be tomorrow? That's why pregame shows before sporting events are so popular. Who's going to win? Who's going to play well? Well, people want certainty in the face of uncertainty, and they love forecasts when it comes to the economy, when it comes to the stock market. I take a whole different approach. All we can go with is the data that we have right now and evaluate that and say, okay, the probabilities are that we're going to go up, we're going to go down, we're going to go sideways. And then the next day we reevaluate things again. And then do we reach the same conclusion or a different conclusion? That's kind of where I come out. All right. So then tech earnings have grown faster than the market in the last decade. Well, yeah. Okay, this is kind of, you probably should know this. World tech, that's still the dominating force, and their earnings have gone up a lot more than what we've been seeing with the rest of the world. And this is a trailing earnings per share. And then they indexed it back to 100 so that it comes up looking really nice on a chart. And they only go, yeah, they index it to 2009. Okay, then the equity risk premium, and I do show a chart here in just a moment where I we look at this every day. It's just this is a different look here. It's at a 24-year low. All right, well, this is a longer term chart. I look at a daily chart. Now, this is how much risk are people taking on to own stocks? And right now it's low at this point. And so is it better to get into stocks or would it be better to get into bonds? Or if bonds aren't doing well, which bonds have been doing well, they're one of the better performing assets in 2025. But if they weren't doing well, then maybe it's better to get into cash or into gold. It's like, what kind of risk am I taking on by owning these stocks? And the you're being compensated less when this is coming down. We kind of use this like a sentiment gauge also. When it's going up, that just shows more fears in the market because the equity risk premium does go up at that point. But this longer term look kind of gives us a little different perspective. And CEO confidence index, it really dropped off. Folks are just unsure about what's going to happen at the company level. And it's kind of going sideways right now, but once all the tariffs came out and the uncertainty surrounding all of that, we just saw confidence really dropping. And then we're seeing that I have to move this little bar here. The when we're coming down here, this is when we hit the low, all right? And then we're coming back up a little bit. This is just how far did we fall kind of a thing. And then this is the risk appetite indicator where, okay, we're going down, so people don't have much appetite for risk. And then we start to come back up as we've been bouncing up out of that, basically. All right, then the dollar's dropped around 8%. Well, okay, now I'm currently not living in the US, even though I'm an American. And about 5 weeks ago, I had to go to a different country to get some currency. And just in the 5 weeks, the value of the dollar has dropped 10% personally for me. And so it's like, okay, now you look at the exchange rate, you go online and that hasn't changed, but the under the surface, yeah, it's fallen about 10%. So, but this is talking about an 8% decline. All right. Then mentions of AI in earnings calls, it's actually dropped off a little bit because folks are kind of accepting AI is where we're going. I use it every day, all the time now. Probably a lot of you do too. And it's just, it's a, if you use it, depending on how you use it, A lot of times it can be just like a fast Google search, where instead of putting in something into search and then you get a million results back, well, you just put that same thing into AI and then it goes out and looks at all those million places and then brings back a summary, which to me is a pretty handy thing of doing. But it is dropping off, but it's still the real talk. And you see AI all over the place now. This is kind of it's a screenshot from a video where it looks like, okay, what's happening with the trade deal between the US and the UK? Well, they're going to be increasing new market access by 5 billion. Revenue is going to be up, or external revenue up 6 billion. Well, this is interesting here, where the tariffs that we had on the UK were at 5.1%. We're going to lower those. The tariffs on the US that the UK is putting on the US, we're at 5.1%. Those are going to go down. So that works more in the US favor. But we were already just at 3.4% with the tariffs in the UK, and now we're bumping them up to 10. So, okay. And how much of this is actually worked out? So, unprecedented access to the UK market, all these different things will now be available. So, you know, all right. So we used to belong to them, and then we had one war to break away from them, and then a second war, the War of 1812, when we almost lost our independence. But hey, that was a long time ago. We've worked out our differences. We went through World War One, World War Two together, and now we're buddies. So you're our best ally. Let's sit down and work out a deal here. But is there really a lot of substantialness? Is that even a word? To this deal? So, all right. So here it's really kind of scary looking here. It's like you're climbing a mountain and you fell off the other side. But we did gap up here. I saw some selling going on, really volatile right here after the open. And then things came out and, oh, maybe it's looking a little more positive. And that's when we finally broke above R1. We got above R2. The dash line here is 5,700 because it's more psychological. And we were able to stay above that for a lot of the day. We chopped above and below it. But then this is what concerns me. This is the last 30 minutes. Each one of these bars is 10 minutes. So we have 10, 20, 30. This is the smart money coming in and selling, and it took us down below R2, and we came all the way back down to R1. That's not real good. I mean, to see a little bit of a trailing off is one thing, because you have folks that are day traders or they're closing out shorter term positions, but this was right. We gave back a lot of those gains, and it makes the daily bar not look all that strong either. And we're flat to a little bit up now in the initial overnight session. This is still looking more positive, though. The blue line's above the red line. We want intraday growth, which is blue, to be outperforming intraday value, which is red. And overall, this is still looking pretty good. The S&P growth to value ratio intraday chart, we want this to be going up the way it is. That's more positive. End of day chart, growth was up more than value for the large caps. It was up less for the mid caps and up less for the small caps. And small caps had a pretty good day there. So we are going up on the end of day chart with the small cap growth to value ratio. We're just barely hanging on to an uptrend. This is positive, and this is what we want to see in a more positive environment. Also improving with the mid caps, and we're still in a downtrend, but we are improving here a little bit. You see, just barely a tick up. We want this to just scream up here to be more positive with S&P growth to value. And we're just stuck in the middle of the rainbow with this other growth to value ratio. Not really improving all that much with discretionary to staples. We want that to perform better if we're more positive on the market. And here's where we're drifting now into a trendless environment. I've been talking about the ADX. That's average directional movement. It's kind of the basis of the technical analysis indicator library that I use. Or the black line, that's the ADX, and it's coming down. We've already been below 20 in the short term, and we're below the moving average. I put the moving average on here to give it a little bit more context. And we are positive. The green line is just a little bit above the red line. So that's switching back to positive. But the fact that we're below 20, that means we're not trending. And we're seeing a very similar thing here. The green line is just barely trying to come above the red line. We're now dropping below 20 here with the intermediate term. And this is kind of the foundation of what I use to determine the condition of the trend, and we're still below the moving average. Volume below average, and we can see lots of less than average red bars on the histogram here. Sentiment, we are coming down since we had an update. We're actually dropping under 23. That's good. And the momentum's clearly down, but we're still above 20. That's the concern. And we're also dropping off here with the VIX of the VIX. The momentum of the VIX continues to be down. And we just kind of flat here with this one fear gauge, and we declined with this other fear gauge. So we are seeing a bit of fear coming out of the market. All right, for the first time in 11 weeks, we have the individual investors not extreme negative. They were camped down here for 10 weeks. They bounce back up, but they're still negative. They've got a long ways to go to get back up to zero. And so that's the red line here is a 50 period moving average. That's continuing to come down, meaning that overall sentiment among individual investors is still quite negative, even though it's improving. Yeah, looking at the equity put call ratio, saw a big move up with the daily chart. We're going up with the 5-day chart, and we're actually still declining here with the 10-day chart. Seeing a little bit of an improvement here. The risk on to risk off ratio is starting to go up. In a more positive environment, we would see this going up, but we need to see more follow through here. And the high beta to low beta ratio also going up, but we need to see more follow through to be more positive. This is the volatility risk premium, getting very, very low readings down here as well. Just not a lot of perceived risk, or folks are not getting compensated for the risk that they take on by owning stocks right now. Advanced decline line still looking positive here, above the moving average based on price and volume. So that's holding up. But we're coming down with our advancers minus decliners over a 10-day. This works out to be an oscillator where we go above the red line. We've been coming down. And to see this come down on an up day, little bit of a negative divergence there. We are positive with our advanced decline ratio. The blue line is short term, the red line is intermediate term, and we're looking better here. New highs continue to improve. We're seeing more green than red, red green, eh? And so we're going up with the 5-day, and we're just really slowly going up with the 10-day moving average. We are positive, but declining here with accumulation distribution right here. But we're actually turning negative with the Chaikin money flow. This had been looking stronger earlier in the week. It turned down, and the red line's starting to go down here. And as of last Friday, when we had a pretty solid up day, this was going down, and this continues to go down. This is our third smart money indicator, the Chaikin oscillator. It's negative. And a little bit of an improvement here with the vortex. The green line is above the red line. We're above all the moving averages here with our advanced decline line studies. And this is the stocks in the S&P above their 20-period moving averages. We had become extreme after last Friday. We were working that off. We're improving, but not extreme right now. This is showing that the short term is still holding up fairly well for right now. And we're doing okay, but not great with the intermediate term. We're above 50 with the 50-period moving average, but we're still below 50 with the 100 and 200-period moving average study. Then here's the chart of the short term where we're still above the 50-day moving average, but below the 200-day moving average. And we're still having a hard time breaking above this previous pivot point. Now, we broke through it on an intraday basis. That's at about 5,700, but we can't seem to get above that. That's kind of becoming that 5,700 level. It started out as more psychological. We were dealing with it on the way down. We broke through it, then we tried to get back above it, then we broke down below it again. So it was, we waved at it as we were bouncing around on the way down. Now we're trying to get back above it on the way back up, if the market's able to do that. So a little bit of an improvement with the 20-period exponential moving average, and we're still well above 50. We're seeing an improvement with the 50, and we're just barely crossing above 50 with the 200-period moving average on the S&P. And then we have our short-term indicators. The Stoch RSI, extreme positive. That's just showing good upward momentum. Williams percent R is extreme positive. CCI 14, not there yet. But the CCI 20, just barely above 100 here, showing some pretty good short-term momentum. And then we're extreme on all three charts here. Short-term stochastic, that's a further subdivision of the short-term time frame. Coming down, trying to turn up a little bit here with the intermediate short-term stochastic. We're extreme with the long short-term stochastic. Still positive with the force index. The condition of the short-term trend, we've actually started to fall below this green line. Now we're coming back above it. That's good. That shows some improvement. And both lines continue to go up. And so we're continuing to be above the 20 period simple and exponential moving averages. And we've gone from the +1 channel into the +2 channel with the standard deviations chart. So that's an improvement. Then intermediate term, looking pretty positive here with the balance of power. It's going up. And we're actually switching to positive with the go, no go. We went to deep purple, then light purple, then brown. Now we're switching over to blue, and that's a positive sign. So this chart is actually looking more positive, and we're looking positive here. We have the fluorescent green line, which is going up and actually showing the upward trend that we've been seeing. And we're coming up here to the blue line, which is the highest high value. We're above the midpoint and advancing. We're positive with the Landry light, that's green, but we're still negative with the proper order. It has a red background. That has not switched over to positive. And the TTM squeeze, after spending 2 days with the darker blue, it's starting to go back up to the lighter blue. But man, look how extreme this thing is. You can see it more here. It's a higher reading than what we've seen on this chart. We're still positive with the ease of movement. We're above zero. And we're positive with the Arun. We're above zero with the oscillator and going up. And we're coming back up here with the S&P McClellan oscillator, not extreme at this point. And then anytime we're above zero with the McClellan oscillator, the summation index based on price is going up, and we're continuing to go up based on volume. The NYSE McClellan oscillator still above zero, so that's positive. It had become extreme. It did bounce up, but not with a lot of real conviction here, but it's positive. And so we're going up with the summation index based on price and volume for the NYSE when looking at the summation index there. And we're turning back up with the Swindler Trading Oscillator. This had been going down, and we're now turning back up based on price and volume here. So that's positive. Momentum is positive for the PMO, and we're going up based on price and volume. And we're no longer extreme, but getting pretty decent readings with the PMOs that are rising. The buy signals are leveling out after becoming extreme. That's why this chart's on the list. And we're still showing an improvement with the PMOs that are above zero, but we're neutral with the Elder's Impulse system for the S&P. Positive, though, with the parabolic SAR, with the dots underneath. This is where we were concerned. We were rolling over with our short-term oscillator, the slope oscillator, threatening to drop down below the moving average. Well, with Thursday's up move, we've turned back up, but we're still looking quite extreme positive here. The MACD, more short to somewhat intermediate term, that's still positive. And so when we look at the momentum, we're worried about the slope oscillator, but the other ones are still positive in the short, intermediate, and long term. Copy curve rolling over a little bit, but still quite positive. And longer term, where sometimes when we got about to where we're at right now, and we could go up more, but sometimes this would mean some kind of a top in here. Sean trend meter just turning up a little bit. It's still more in the yellowish, more neutral area, but the context is that this has been improving. Still above 50 with the money flow, declining but above 50 with the ultimate oscillator, above the moving average with on balance volume, above 50 with the RSI 14 and 9. The intermediate term trend still looking good here. Blue line's going up, the red line's going up. And we're above the 50 period simple and exponential moving averages. This is kind of some overhead resistance. The 100-day exponential moving average. We got a little bit above it, then we were below it, then we dropped a little bit down. Now we're dealing with this level for right now. Now, just to give you a little bit of a backstory here, 15 years ago, I didn't use the 100 period moving average. I would look at the 50 and the 20, the 50, and the 200. Well, we went from about 2011 to about 2016 or so. We were doing okay, but the market was going up, but we would have our downtimes, but it wasn't trending really heavily. And I started to implement the 100-day moving average during that time because I wasn't getting the insight from the 50 and the 200. I needed something in between. And that's when I started using the 100. And now that we're back to dealing around this level, does that mean that's coming back into play? I don't have an answer for that. But I've seen this happen before where we're kind of bouncing around above and below the 100-day moving average. So that might mean if we stay in this area that we're in, that we're going to be dealing more with the 100 period moving average, which means we're probably in more of sideways type of patterns. And then here's the spaghetti mess with the moving averages here above the 20 and 50, below the 200s, and right at the 100s. All right, getting far away from the 20 period moving average. That's what the boom indicator is measuring. We're getting far away there. We're looking okay with the 50 and the 200. And after kind of topping out here with the bullish percent index, we ticked down a little bit. Saw a little bit of a tick up, but not a huge move up here. But we are still positive with this. But we're above the green line, and that's when we start to become, we just watch this chart even more. We're above 50 and going up with the NYSE bullish percent index and still getting an extreme reading with the NASDAQ 100 bullish percent index. And just wanted to show this because we tried to get above the 61.8% retracement level. That's some of the overhead resistance that we hit last Friday. We got above it on an intraday basis, but then ended up closing well off of that. And this is longer term positive, where we were able to recapture this 55.75 level at this pivot point. This is a weekly chart. And so far, we're above it. Can we stay above it? So we want to be able to close at 55.75. We're a little bit down from that right now. If we fall back underneath this with by the time we close on Friday, that's going to be more negative. If we can stay above this, that will keep things more positive longer term. And looking more positive here with the Heiken Ashi. We're positive with the Kagi chart. It's black and pointing up. We're positive with the Renko chart, and we're positive with the three-line break. So trending basis, we're still looking okay there. And we're looking okay with our 150 and 200 period moving averages. They're continuing to go up. And now we're still no changes here. I don't know if they haven't updated this. I get this from stockcharts.com. Positive across the board in the short term with all the stock indexes, negative in the intermediate term. We're still negative in the long term with the mid caps and the small caps. And I guess they updated this part. The dollar is actually in an uptrend in the short term. It was across the board negative, where commodities and bonds based on price are negative across all time frames. And so we're seeing industrials, materials, those are more cyclical. Then we have discretionary here. That's one of the areas we want to see do better. Tech, that's also growth. Communication is another growth area. Then we had staples, toilet paper, toothpaste, real estate, utilities, healthcare. These tend to be more defensive, and they were actually down. So we saw growth doing better and economically sensitive areas doing better in Thursday's session. A lot of green or blue, depending on what color you see here. The NASDAQ was able to get above 17.8, 17.9, 18,000. Energy had a BPI across above 50. All right, that's showing some strength there. The dollar got back above 100. Materials, again, more cyclical. If the economy's going up, they do better. If the economy's going down, they don't. Had a BPI cross above 70. We got above 5,700 with the S&P, but we didn't stay there. We closed down below it. And then we had a BPI cross above 70. That's what I showed just a minute ago in the chart. The financial sector. We like the financial sector doing well. I went through the great financial crisis, and that's why I watched the financial sector and I watched the banks. We had a BPI cross above 80. And here, this is newer. You might use this every day, but I haven't. I just recently started showing this in the videos. This is the market carpet. And the biggest part of the market is all the way over here on the left. This is tech. It takes up the top part and the bottom part with Microsoft, Apple, and Nvidia taking up half of the tech sector. That's why we watch these stocks so heavily. Then we have the financials. A lot of green here, except Berkshire Hathaway. Okay, I guess Warren Buffett's going to step down there. Maybe they didn't like that. But that announcement came a number of days ago. Healthcare, a lot more red, but some green, but the bigger parts are red. That just means how much of a weight does that particular company have in the overall sector. Industrials, yeah, a lot of green here. Staples, a lot of red here. Walmart is the biggest player there. And then we look over here, discretionary, Amazon, Tesla, with Amazon being the real biggest part of that. So if Amazon does well and Tesla does well, that helps the discretionary sector. And we want discretionary to outperform staples. which are way back over here. We like a lot of green here. We want a lot more red here if we're positive on the market. Communication, Google, Meta, Facebook. Those are the two big stocks there. Then we have energy, utilities, real estate, and materials. They take up less of the overall index. So the Dow is trying to get back above its 200-day, 50-day moving average here. And so this is resistance, but for right now, it was able to get above that. But you can see it closed well off of its high here. And we're still neutral though with the diamonds, with the Elder's Impulse system, closed well off the high here with the NASDAQ, but above the 50, below the 200. Neutral with the Elder's Impulse system for the NASDAQ. Still having a hard time getting above the 200-day moving average with the NASDAQ 100. This is critical. And the NASDAQ 100 is the growth area of the S&P 500. So if this one's kind of struggling, I mean, it was still up 1%, but closed well off of its high here. So if it's doing well, that helps the S&P to do well. Neutral with the Qs when looking at the Elder's Impulse system. Momentum for the Nasdaq 100 is positive. Finally breaking a little bit above its 50-day moving average with the S&P 600 small caps. And we're also back up above the 50-day moving average with the Russell 2000 small caps. And we're positive with the small caps with the Elder's Impulse system. We're coming up a little bit above the moving average with the mid caps, but we're still neutral with the Elder's Impulse system for the mid caps. Right in between here, the Wilshire 5000, a broad market measure, above the 50, below the 200. Total U.S. stock ETF, above the 50, below the 200. Can you see here? We're kind of just in this little range right now. Financial sector, a little bit stronger uptrend here, above its 50-day moving average. We like that to do well. The FANG index generated a recent death cross, and since that day has been above both moving averages. Isn't that interesting? These are the real big stocks: Facebook, Apple, Amazon, Netflix, Google. Apple up, but in a downtrend. Amazon up, but in a downtrend. All right, Microsoft above its moving averages and doing well. It had a good earnings report, and that's been helping the stock a little bit, but it's trying to recover from being in a downtrend. Google was up, but in a downtrend. Meta up and actually in an uptrend above its 50-day moving average. It was only up 0.2%. Nvidia up a little more than 1/4%, but also in a downtrend above its 50-day moving average. Tesla in between land here. It was up 3%, but not above its 200-day moving average yet. And you can see that can often act as overhead resistance. Netflix, the best looking chart here, it was down 0.95%, but just setting a series of all-time highs here and doing pretty good, even though you see some profits being taken lately now. And look at the short-term correlation between U.S. and world stocks, still pretty high there. Little bit of a move up here with our longer-term correlation. Keeping an eye on this, this is the SPY, which is the ETF for the S&P 500. Staples, toilet paper, toothpaste, the things that people have to have no matter what's going on in the economy. We're improving with this overall ratio. We're starting to come back up, and that's good. But what we saw at the end of 2021 is this really breaking down. Now we're chopping around more this time than what we were. This was more definitive at the end of 2021, and then we went into the bear market of 2022. But we still want to keep an eye on this. It doesn't necessarily mean that we're going to be falling apart, but this is just something that we're watching day in and day out. Oil coming back up to $60 a barrel after getting into the mid 50s. The dollar's back above 100, even though the way I measure it, we're still in a downtrend. And the Dow, why is the Dow on here? I think, okay, I forgot to delete some charts. I apologize for this, folks, and I don't want to go back and delete these and start this video again. So I'll just, just if you forgot what happened yesterday, okay. All right. Sorry about that. Okay, then looking at the latest reading of inflation as put up by Trueflation, up 1.6%. That's what we have it inflation as. That's under the 2% rate that the Fed is using. But unfortunately, they use the core PCE as their main inflation gauge. They don't look at Trueflation. This is one of the newer charts that I've been showing lately, just a different take on how inflation is measured. There's other sites out there that would have this at like 12%. So That's why I'm a little skeptical of this because I haven't spent a lot of time. I don't really know what goes into this particular chart for them to achieve what the result that they're getting here. Okay, and we're going back up again here with the 10-year yield, but we have stabilized overall with bonds. We came down, dropping below the 50-day moving average with bonds based on price. And we're back to being normal again with the 10-year to 3-month yield curve. And still looking okay here with the Q to S&P ratio. This is growth versus value because the Qs, that's growth, where the SPY, that's growth and value. And it's better when this is outperforming. We want discretionary to be outperforming the S&P. We're still pretty much flat here, coming down a little bit, but we're above an advancing moving average when we compare large cap growth to large cap value. So we're above the moving average with the large caps, mid caps, small caps had a nice little pop here. Outlook for Friday. We're still positive in the short and intermediate term, negative in the long term. We don't have any economic reports coming out. And then what else develops here? As far as with the trade wars, with the tariffs, with any more announcements, um, and then anything geopolitical. There's the war between Russia, Ukraine. There's things going on in Israel. There's Pakistan and India. That's becoming a little more heated, and that's not necessarily a good thing. So there's a lot of things to just keep an eye on to see if they end up having an impact on the market. And no reports coming out on Friday. We're finished with this economic calendar for the week. Where we look at May 9th, we're negative with the Dow, we're neutral to negative with the S&P, we're neutral to positive with the Nasdaq. So not really much of an edge there. And seeing a low, now this dash line, this is just post-election, where the previous chart, this goes back to 2002. So it's a little different way of calculating these numbers, where we do see a little bit of weakness during a post-election year. And then this is a chart that I update on the YouTube community tab, and I also have it here. These are pivot points, and the cool thing about these is we know this all ahead of time. These are Friday's pivot points, and you can see by looking at this chart, yeah, they're pretty critical. This is when I talk about R1, R2, S1, S2, and this kind of shaded blue area here. That's the range that we're looking at for Friday. So I just posted here for informational purposes. If you want to actually look at this chart, go to the YouTube community tab. All right, so we're still negative when we look at the long-term growth to value ratio for the S&P as well as the discretionary to staples ratio. The moving average studies, we're still below 50 with the 100 and 200. We're above 50 with the 50 period moving average study. The 20, that's actually showing more strength, but you can see the 50 is kind of lagging behind there in the intermediate term. It did decline after being extreme positive. That was a week ago. Well, it was Friday, last Friday. We had a nice solid update after the employment report came out, and we had an extreme reading there. It's been pulling back since then, but holding up in the short term. But the reason why this is on the warning sign is because of the 50, excuse me, because of the 100 and 200 period moving average study. And then there's a chart that I show over the weekend, a long-term oscillator called a special K. That's still negative. All right, and now we're still above the moving average, but declining with accumulation distribution. Chaikin money flow and the Chaikin oscillator are negative. I actually could have switched these over to the other side, but I like to keep them all together, hence the bracket here. All right, then the McClellan oscillators and summation indexes for the S&P and NYSE are still positive, and the bullish percent indexes are positive, the parabolic SCR, and they're gold because these are primary. This is in yellow. This is the Swinland trading oscillator. It's not primary and it's not secondary. It's kind of like in between land. That's one of those other areas that when you go to Disneyland, in between land. So it's because it's really good sometimes at really helping. Other times it can really lead you astray. So I don't really treat it as a primary indicator. And then we're above the 20 period moving average study. It had been declining. It's hanging in there for the most part. So that's why it's on the positive side. We're still positive with momentum. Notice these are white, so they're more secondary. Ease of movement, money flow, secondary. They're positive. Ultimate oscillator. The vortex I do treat as a primary indicator. That's positive. Financial sector and the momentum for the NASDAQ 100 is still positive. All right, the conclusion. We're positive in the short and intermediate term, negative in the long term. That hasn't changed now in quite some time. In the short term, we're positive, but the late day selling, that's a concern. We saw it earlier in the week too, when we were looking pretty good and then it trailed off going into the close. And that's, I mean, it's okay to pull back a little bit, but this was almost a full reversal that we saw. In the intermediate term, we're positive, so we're improving. And we are positive since we're above the 50-day moving average, but we're seeing most of the strength right now coming from the short term. Long term, we're negative since we're below the 200-day moving average, and the recent death cross shows that we're now in a downtrend. Thank you. I really hope you found this helpful. Have a great day on Friday, and I will talk to you in the next video.